Good morning, good afternoon, and good evening, folks, depending in whatever time frame and time zones you are based in. I am based in London, in the United Kingdom, where we are mourning about the death of the Queen Elizabeth II. Very saddened by her death, everyone here at AvaTrade, and our condolences for her death, and I'm sure that you guys must be watching the live coverage of that as well. A bank holiday has been announced on Monday, so again, the whole nation will be mourning on her funeral day. Nonetheless, today's webinar is more about the actual mourning that is taking place in the markets, and that's not because of the death of the Queen, but in fact that is on the back of an important economic data which was released yesterday, which has changed the state for all markets, especially for the US markets, because traders and investors have one concern on their mind, and that is about inflation. Now, what is that concern? How is that influencing their trading decision? What is the outlook for the market? What can we learn from the sector performance? That would be all covered along with many other important points in this particular webinar. So if you are with us, you are in for a treat, and as you will get to learn not only the major fundamentals, filtering out all the noise and paying attention to the price levels and important price levels only. But if you guys can hear me loud and clear, please give me a sound check and screen check so that I know that you guys can hear me well and you can also see my screen. It's importantly, thank you, Mutha, and thank you everyone else who have joined us in this particular webinar. Today we are going to cover, as I said, quite a lot of number of things today in our webinar. So first things first. My name is Naeem Aslam. I work as a chief analyst for AvaTrade. I come with a wealth of 15 years of trading experience. And during this time period, I have worked as a hedge fund trader for Bank of New York Mellon, as an equity trader with Bank of America. Many of you may have seen me as a regular guest on Bloomberg and many other media channels. Here are our social media handles. I do recommend you guys to follow us there because we do share important information throughout the day, which is quite essential for everyone in this room. If you have any questions, please feel free to ask us right now. Right, okay, so don't know what happened there. The video kind of paused. While I was running the presentation further. So as always, a bit of a reminder for everyone about risk warning. So anything which will be discussed cannot be perceived as an advice. The full disclaimer is right in front of you. You can read that in your own time. Here is about AvaTrade's unique technology, AvaProtect. Again, please do get in touch with your own account managers who will be more than happy to give you more information. I wanted to move towards the main point of this particular webinar and want to go through the agenda because we do have quite a lot to cover today. So first things first, and because we have a large number of people in this room, some of them would be very beginner who would be only starting their journey today, and then some of them would be like Amutha, who've been here for a very long period of time, and then they know quite a lot of things in the market. So for those of you who already know, why don't you help me with the first particular question so that all the newbies can understand that as well, and that is why to trade indices, why as a day trader, why as a trader, why as an investor you want to trade indices. In other simple words, what are the benefits of trading indices? The answers are flowing thick and fast. Number one is, of course, hedging or diversification. That is absolutely true because diversification gives you that, indices gives you that. not relying on one stock only. Again, that is an excellent answer as well, because that gives that part of that diversification or hedging. Because if one particular stock goes down, but your entire portfolio can very much be impacted by that. But when you are as a part trading the index, you have that hedge against that. And then the second one is, of course, volatility. Great one, that one as well. The volatility for the indices are a lot more higher in comparison to the normal particular stocks, because they move quite a lot. I can't really do this one that good, as you can probably see from here. The writing isn't that really great in terms of it, but the volatility for the indices is really great. So that makes the playing field very, very green for day traders, because they have a huge range to trade from on a daily basis. For example, on certain days and very often, what happened in terms of the Dow Jones Industrial Average, which represents the top 30 stocks over in the United States, it can move anywhere between 500 to 1,000 points without any problem. So that is quite an important and an interesting point to pay attention to. Now, can someone in this particular room please give me a name of 3 major stock indices over in the United States? I've already given you the first one, which is the Dow Jones Industrial Average, also known as the US 30 Index. What are the other 2 indices? Come on, guys, let's get them going. Let's those fingers get going. Give me an answer of that. What are those ones? What are the major ones? Right, okay, so US Tech 100, which is known as the Nasdaq, as absolutely correct. So the Nasdaq index is the next major index over in the United States, which represents the entire tech sector over in the United States. And on our platform, this is known as US Tech 100. So if you just look for that symbol, US Tech 100, that is basically your Nasdaq. And the third and the most important one is the S&P 500 index, as you guys have mentioned in your reply box. Thank you for replying, because I like that interaction from you guys. I want you guys to be awake and also answer the questions, guys, right? So that's what you guys are doing. So the S&P 500 index, which on our platform is known as the US 500 index. Now, the same thing kind of goes for our the European indices as well. So over in Europe, we have the German stock index, which is known as the DAX index. This is your German stock index. And the second one is known as the CAC index, which is your French index that represents the top 40 stocks over in France. And then similarly, you have IBEX 35, and then stock 600 and stock 50, representing the entire European stock market with them. And in Japan, you have the Nikkei. In China, you have the Shanghai index. So the list kind of goes on, but the major and important one, and of course in the UK, you have the FTSE 100, known as the UK 100 index on our platform. But the major ones to focus on is, of course, the UK 100, the DAX, and the CAC. And then over in the United States is the S&P 500 index. Now, what happened yesterday? The second question is, why have the markets fallen so much? So why the markets have fallen so much is because yesterday we had the US CPI data. Now, for those of you who do not know what CPI is, CPI basically is your inflation data. Inflation is that how much money does it cost you to buy the same goods now in comparison to a month ago, in comparison to a year ago, in comparison to 5 years ago. But mostly it's compared on year-on-year basis and on month-on-month basis. Now, we all know that the cost of filling our cars is not the same as it was a year ago, because over in the United Kingdom, it certainly has doubled for us. So that means that if it was costing us to fill up my car, if it was costing me to fill my car £70, now the same damn thing is costing me over £200 or £150 if it was before it used to cost you £70. So that is the matrix that we are really looking at. And the same goes against groceries as well. The stuff that you used to buy with £5 before is costing you £20 now to buy the same amount of groceries. That is inflation in the United Kingdom. Welcome to new world over in the United Kingdom. Now, because of that CPI inflation moving so much to the upside with nearly 40 years high over in the United States, inflation readings have shown absolutely stubbornness over in the United States yesterday, and they failed to move to the downside. The reading came higher than the expectations of 8.1%, and now traders and investors are worried that the Federal Reserve, whose primary function is to control inflation, is going to increase the interest rate more aggressively. Remember, the Federal Reserve has been increasing interest rates since last year because they think that doing this can control inflation. Now, markets, the S&P 500 index, the Nasdaq, and the Dow Jones Industrial Average, they do not like the Federal Reserve to increase interest rate, or in other words, a hawkish monetary policy. Now, because the inflation did not show any retracement, did not show any weakness, did not show any gas coming out of the particular rally that we have seen, traders are worried that the Federal Reserve is going to take another aggressive hawkish step towards their monetary policy, and that has caused a major chaos in the market, which we will see it in a bit, and that has pushed the markets to the downside. Now, of course, the reaction is also seen in the DAX, for the CAC as well yesterday, for the FTSE 100 as well, because markets are very much related and very much correlated with each other. So what happens in the United States, the spillover effect are always felt over in the Eurozone, in the United Kingdom, and in Asia as well. Now, what is a VIX index? A VIX index is certainly very, very interesting index. This is called the volatility index. It has a very interesting relationship with the S&P 500 index. What is that relationship? The relationship is very, very simple. When the S&P 500 index moves to the upside, what we see generally on the VIX index is that it moves to the downside, because this represents a risk on rally. When there is a risk on rally, the volatility index moves to the downside. When the volatility index moves to the upside, the S&P 500 index over here, it moves to the downside, because a volatility index over here moving to the upside, meaning it means that the risk of rally is here, and that means the S&P 500 index moves to the downside. This has happened in the markets yesterday because this was a risk off day. It was a risk off day over in the United States. And as a result, we did see the S&P 500 index moving to the upside and the S&P 500 index moving to the downside. Now, of course, this has increased those particular concerns, which begins with this word called R, and the word is called recession. Now, that means that the Federal Reserve is going to increase the interest rate more aggressively. Will that hamper economic activity, economic growth, economic GDP numbers over in the United States, and will all of these lead to the US economy into a recession? A threat which was dissipating to some extent not too long ago, but yesterday the CPI number has once again strengthened those concerns, and markets have started to overreact, and we saw markets selling off. Now today, of course, the futures are indicating a little bit of a rally, with which we will see it very shortly. But so far, are you guys clear what we have discussed in our webinar? If you have any questions, now is your opportunity to ask me that particular question. The question is coming, what is the index for Europe stock? Okay, so the index for the, excellent question, Amutha. So the index for the European stocks is called Euro Stocks 50 and Euro Stocks 600. So these are the ones which we have for the European stocks. Remember, the situation overall in the Eurozone remains a lot more fragile, a lot more worse than the United States because of the ongoing energy crisis, which were triggered because the Eurozone has engulfed itself into a war which perhaps it shouldn't have, because now they are talking about they are involved in a war, in an indirect war with Russia, which is cutting energy supplies for the Europe and for the United Kingdom. As a result, we have another major crisis on our hand, which we're dealing with. The United States obviously is a major producer of its own energy and is capable of dealing the energy crisis much better than Europe or from the United Kingdom. But because of the US tensions with Russia, the situation has become a lot more worse for us, and we as a public paying the price for that in terms of higher inflation. Inflation over in the United Kingdom is sitting at 40 years high. Inflation over in the Eurozone is also sitting at 40 years high. It's a great question, that, anyway. The next question is, as now higher CPI market predicting Fed going to increase 0.5% or 1%? Alex, that is a great question. So basically the question is, what will the Fed do in terms of their interest rate hike, the next interest rate hike? Well, I think the probabilities are that the Federal Reserve will still increase the interest rate by 75 basis points, not by 1 full percentage point, and they will keep their tone very, very aggressive. And that would provide a little relief to this particular market, which is jumping off the cliff, or traders or investors are ready to push this market to the ground. But when they will see that the Federal Reserve is increasing the interest rate by only 75 basis points, we are likely to see a relief rally coming into the market. Now, the next question is coming up is, so if the US dollar is gone down, why does the euro USD go down? Should the euro not continue going up? So Michael, yesterday the US dollar actually went up. It didn't go down at all yesterday on the back of that, because if the Federal Reserve is going to increase the interest rate, that is positive news for the dollar index. Hence, we've seen the euro dollar moving to the downside. So the path of the least resistance for the euro dollar remains skewed to the downside. Remember that, and then make sure that you are clear on it. But excellent question as always. Thank you for sending all those questions. So now let's continue with our price levels, because I wanted to go through on some important things. I wanted to go through the actual price levels, and as we are coming close to, we don't have too much of a time left. So let me bring that for a second, the MT5 platform for you guys, so that we can have a look at that in a lot more detail. So now what we have in front of us is our MT5 platform. So what we're going to look at is we're going to look at everything. So this is what we mean. Over here we have our BTC, which is your Bitcoin. So yesterday, with the strength in the dollar index, as someone was just mentioning about that, the Bitcoin price has fallen, and it has fallen below two important moving averages. This is your 50, this is your 100. Now, the fact that the price has fallen below these two important moving averages, that means the path of the least resistance remains skewed to the downside, and the price level or the support zone that we are focused on is the lows of this particular year, and that is at 17,391 to 17,920. So that is for BTC. Now, what about Ethereum? Because a massive merge is coming this particular week. The prices have shown weakness on the back of that, but remember, the merge under which Ethereum will become a lot more energy efficient cryptocurrency is supposed to be very, very positive. But remember that it is all about buy the news, buy the rumor, sell the news. So when the actual thing will happen, we may actually see Ethereum prices moving massively to the downside. There is a huge probability of that. That is what I am really betting on as well. So we could potentially see the prices visiting that $1,000 in the coming days, or at least the lowest right over here. As of yesterday, because of the strength in the dollar index, the prices have dropped below the 50-day simple moving average. Now, this is your S&P 500 index, or which is known as the US 500 index. Really, really interesting things have been happening with the US 500 index. What we really see is, first of all, the lows of this year right over here between 3,644 to 3,693. And ever since prices started to move higher, they crossed above the 50-day simple moving average right over here, giving us an indication that bulls are ready to push the markets higher. And that's what really happened. Prices moved to the next level, and then they moved above the 100-day simple moving average, giving us an indication that prices are likely to continue the journey to the upside as bulls are picking up more momentum. And then the price came into this particular area, which was right, the resistance was served by the 200-day simple moving average. The price crossed above the 200-day simple moving average, giving us a very clear and clean signal that bulls are in control of this particular rally, and the market is only going to be moving to the upside and to the upside. But guess what? That turned out to be a completely fake and wrong signal, because prices very soon reversed their direction and crossed below the 200-day simple moving average. That was the first sign of weakness in terms of the price action, and that led the further sell-off in the markets, and the prices came near their 50-day simple moving average, again bringing those hopes among investors that perhaps this is where we will see a rally. But when the prices crossed below the 50-day simple moving average, it was a clear signal that the prices are likely to see even more sort of a weakness, and then from there the price moved to the downside. Now, after that, the price was just shy of this major important support, which was formed by this particular zone over here. The price was shy and it started to move higher, moved above the 150-day simple moving average, and tested again its 200-day simple moving average. Now, the question for investors and traders as we sit over here is, where do we go from here? Is the path of least resistance is going to lead the prices to here? Will this one hold, or are we going to visit this particular price action right over here? Now, listen to me very, very carefully what I'm about to say. Now, the fact that the price has tested the 200-day simple moving average not too long ago, just over here, and the price has tested the 200-day simple moving average right over here, gives us two different indications. Number one is that the prices are ready to move higher, but at the same time, which is number two, prices do not have enough momentum to move to the upside. So for me, to have a clarity that this price is going to be moving to the upside, it needs to do one thing for me, and that is the price needs to cross above the 100-day simple moving average, one, and secondly, the price needs to stay above the 100-day simple moving average. If it falls below that, then the chances are that we are going to be not only visiting this, but we are likely to visit this particular one. If the price doesn't cross above the 200-day simple moving average, then this area is likely to not provide the major support. The major support is going to be right over here. So again, our support zone remains over here and here, with resistance sitting on the top of this particular line. Now, what is happening with the other two stock indices, the other two major stock indices? So let's begin by looking at the Nasdaq, which is exact data copy of what is happening with the S&P 500 index. You can see S&P is trading below the 150, and that is what really happened over here as well. The only difference over here really is that the Nasdaq index over here did not challenge the 200 simple moving average, but it did challenge over here, but the challenge happened only once. In case of the S&P 500 index, we know that the index did challenge that over here, but in terms of the Nasdaq index, that hasn't happened, and that shows a little bit of a weakness. Now, in terms of our support and resistance levels, what we are really focused on is this particular area as our first area of support, meaning if the prices cannot move above, then they're likely to move over here. And then our primary area of support, which is the low of this particular year, and sitting right over here, as you can see on the chart. So these are the price levels that we are very much focused on in terms of the price analysis of the Nasdaq index. Now, let's quickly do the last important index, and your last important index is, of course, your S&P 5, the Dow Jones Index. The Dow Jones Index, what it states for us is very, very clear in what we have seen for the rest of them as well. What it shows to us over here really is that the prices are likely to continue to move to the downside, and the path of the least resistance for prices is skewed to the downside. Let me just do one thing. Right, okay. So what we really looking at over here, let me clear all the drawings over here once again. So what we are really looking over here is where the price is trading for the Dow Jones Industrial Average. We can see and we can learn from the previous analysis is that the price is trading below the 100 and below the 50 and below the 200. Just like the Nasdaq index, the Dow Jones Industrial Average had only one test of the 200-day simple moving average, where it moved to the upside, but it also had another test of the 200-day simple moving average fairly quickly. But the recent rally, this particular one, did not test it. So we don't call this one as a test, really. We will call this one as a test, but this one failed to test the 200-day simple moving average, confirming to us that the prices are showing a bit of a weakness, and the path of the least resistance is skewed to the downside. Now, what does that mean in terms of our support and resistance levels? I am focused on not this particular price level, because this one right over here, which I'm going to just show you on the chart, is already being tested and not likely to hold. So I will be focusing on this level over here and then extending that level to here. So only one level to look at, that is 29,600 to 30,116. I know that this is a little bit of a bigger level to stomach, but that is the level that we'll be very much looking at. So as the Dow Jones Industrial Average is more likely to fall further to the downside than anything else, and that can happen if the Federal Reserve increases the interest rate by more than 75 basis points. 75 basis points is the base case scenario among investors and traders today. So keep that in mind, guys, as we move along. That's it. And for now, the time has finished. If you have any questions, please feel free to get in touch with me through Twitter. Until next time, we'll see you next time. Thank you.